Right, I'm here with Richard Rosenblatt of Demand Media, and we're at the Web 2.0 Summit. Hey, Richard.
Hey, baby.
I'm going to do a quick pan here.
We got Sean Colo there. We got Larry Fitzgibbon eating some cheese. We got Mike Cowan. We got Quinn Daly.
Okay. So, Richard, you launched Pluck on Demand. Tell us about that. What is that?
We did. Well, Pluck on Demand, you can take a look at it at www.pluckondemand.com. It is a new application that allows any website, from the smallest website to a larger website, add basic social media tools and content to their website, all contextually, to help them grow additional page views.
Okay, sounds cool. Let's talk about the overall business. It's pretty tough out there for a lot of sites. With regards to advertising anyway, ad-supported sites. So how's the ad market affecting your properties?
You know what, the good news is the ad market's not affecting our properties very much yet, and that's because we've never had a real strong focus on branded ad sales. We've mostly monetized through cost per click with partners such as Google and a few others, and we haven't seen our CPCs or our volume start to drop yet. We are expecting to at some point, but right now we really aren't that reliant on display advertising.
Okay, if you're expecting it, what are you doing sort of preemptively to sort of offset any declines?
Well, you know, we're just continuing to focus on growing our organic traffic base by producing more and more low-cost, ROI-driven content and continuing to build out more and more communities, so it doesn't cost us anything to attract traffic, and therefore whatever money we make off advertising is just incremental to our business model.
Okay, how's the traffic going?
Traffic's great. Traffic's continuing to grow month over month. I mean, we came out of summer, which is always slower. We were fortunate to still grow in the aggregate over summer, and we're looking forward to, growing throughout the next year.
And are there any particular properties that are seeing more traffic, seeing more of an audience given the downturn?
Seeing more of an audience? Well,
yeah.
I don't know about more of an audience, but we're seeing on eHow a tremendous growth. I mean, eHow this month will have over 25 million unique visitors, up from 4 million 2 years ago, and that's continuing to grow, 7 to 10% month over month.
Okay. How are you managing your properties now during the downturn? Are you doing anything differently?
Well, again, I mean, we just have more of a focus on driving more organic traffic. We've always focused on driving organic traffic. We've never bought traffic, but now we're just pushing harder to grow faster. And at the same time, we are keeping our costs in control. I mean, we aren't laying off any people, but we're not hiring at quite the same pace we were hiring before.
Okay. Are you probably not buying at the same pace as you are, but are you buying any companies? Or are you thinking or considering?
We are looking to continue to buy. I mean, we're fortunate to be profitable. We have a significant amount of money in the bank from the amount we raised, and we think it's a great opportunity to grow.
And what are you looking for? Should I ask Sean?
Why don't you ask Sean, right over here to my right? Hey, Sean.
Sean, here. What are you looking for?
Well, we've traditionally purchased profitable businesses, so businesses that were growing, and maybe they weren't super high growth businesses, but they were profitable and had really smart people who we thought we could leverage not only that business or that asset, but that skill set really across the whole company. And so that's generally been our model. At the lower end, or even up to the higher end, some of the larger deals, where we bought great development teams and great product guys, because really, as Rich talked about, I mean, a big piece of our business is continuing to innovate on top of the media assets that we own. So that's what we're looking for. And we're also, I'd say, even in this market, we are still active. We've got a pretty big, full pipeline of deals, but we're looking to build out and exploit some of our existing verticals as opposed to really sort of going more broad.
So can you be a little bit more specific for anybody sort of watching in terms of if you're going for a niche site, are you looking for a particular type of content, and what exactly are you? Not exactly, but a little more.
As I said, I think within some of our existing categories, which are kind of health, wellness, and fitness, active outdoor lifestyle, entertainment, we've got a site called cracked.com, which is doing really well in the comedy vertical. So anything that can really kind of bolster or add more value to some of our existing sites, those are some of the things we're looking to buy. Great,
cool. So you've been doing more of the operational stuff. Sean's been sort of doing a lot of the acquiring stuff. From an operational standpoint, so what type of synergies have you have been there? What are the things that you thought would work that didn't work, and what are the things that are working?
Over the last couple of years?
Yeah, as you bring all these properties together.
Right. So I mean, most of the stuff that we've really focused on, we've been fortunate. We've got a great team, and they've worked. Right. I mean, we really have three main pieces to our business, and we've said this since the very beginning. One is building out a passionate vertical network that grows through social tools and social media. And we've done that, right? Our network's grown to almost 70 million unique visitors. Through the recent acquisition of Pluck, I think it's about 4 or 5 months ago, we've been able to add social media to websites all the way from USA Today and the Washington Post to people like the NFL. Mm-hmm. So we've been very fortunate to be able to grow our own properties and others through social media. And then the third part of our business, which we're just starting to talk about now, and I think actually you interviewed Stephen Kidd, is our studio, which allows thousands of content creators to create video and text in order to fill our properties and fill our partners' properties with content. So, I mean, we've been really, really fortunate. I'd say the only thing we haven't done a great job on yet, and there's more than a lot of things, one of the major things was display advertising. So we now are focusing this year on building on a branded ad sales force, even against the market conditions, to really begin starting to, raise the value of the advertising on our network.
And what are the advertising rates right now, or CPMs on your network across the board, and where do you see them going next year?
You know what? They really vary per property, so I don't have a great answer for you. I mean, they're very high on properties like eHow. They're lower on our entertainment comedy type of properties. I think
what's high?
What's high?
Yeah.
In the 20s plus.
Oh, that's good.
Again, that's more of an RPM, but
right.
a good page. Where we think coming into the next year it's definitely going to be a more challenging market. But again, we have such niche properties that if people are interested, for instance, in advertising to a golf audience, come on to Golf Link, right? Because they're all there to golf. So we think that should probably garner a much higher CPM than someone that's trying to do some fancy way of behavioral targeting to figure out whether or not there's a golfer. So again, in the face of the economy, we are concerned about it, but we're not going to slow down. We plan on continuing to grow. Maybe that's against the grain of what everybody else is saying, and take market share in the coming years.
Okay. Well, good luck to you, Richard.
Thank you.